Good evening, everyone. Thank you for joining us tonight on The Subtle Art of Not Giving a FUD. I'm Crystal, the Community Manager at Prosperous. Tonight, we have with us Billy, Investment Coach at Prosperous. Billy is passionate about capital market and believes in investing for the long haul. Prior to this, he was an economist at RHB Investment Bank, covering Thailand and the Philippine markets. He also worked as a financial journalist at The Age, Malaysia, and has experience working with an asset management firm. Billy is now the investment coach for Prosperous and focuses on reaching out to the new generation of investors. So without further ado, I'll hand the time over to Billy to start the session. Billy, over to you.
Hi, let me just share my screen. Okay. Okay, so today's topic is basically about trying to understand the different psychological states of mind for investors, especially those who are starting to invest in the stock market or even different asset classes. So before I start, I just hope you guys had a quick dinner, already had a quick dinner, and hopefully this session will help you to learn to manage that emotion, especially during the bear market, which is probably what we are facing currently. Now let's just go on with what do we mean by the subtle art of not giving a FUD. Now, FUD here, it means fear, uncertainty, and doubt, right? So especially during a bear market or when market collapse, especially if you're investing, for new beginners especially, you probably feel a bit of panic, right? You probably feel uncertain about what's next. I'm just going to give a quick example. I mean, if you are familiar with the crypto market today, Bitcoin was trading at above 60,000 just about a year ago. Today it's below 20,000, right? So that's the kind of panic that we are talking about. So there are a lot of reasons that or factors that are driving the stock market movement. We can talk about the US Federal Reserve. We can talk about basically the slowing economy, or we can blame it on COVID, the transition to normalized economy. But regardless of what the reason is, for every investor, you need to learn to manage that sort of emotion, especially when things do not pan out as according to your plans, right? So if you look at the pictures here, one of the reasons why I show this is because when you are uncertain, when you have doubt and you have fear, it's best to run to people who are familiar, who are in the industry. So for example, you can talk to Prosperous. We are a digital brokerage, so we will be there for you. Or you can also talk to your investment advisors, people who can actually advise you on those issues, because, well, your money is at stake and you're probably more emotional than the professionals who will be able to give you a more rational investment decisions. So that's basically what we are trying to do today, to help you to learn to reach that rational investment decision making. Now, let's look to our first slide here. So it's all about battle of the mind here when we talk about the psychological states when investing. So I'm just going to show these charts to you guys. So when you started investing, it's a lot of emotions that are involved. So you started off very excited, right? You are very optimistic about the market, and you always talk to your friends about the stock markets until you reach a certain point of euphoria. But when the stock market starts to collapse, then there's fear that comes in, and then you start to become panic. And then, of course, you go into despondency, depression. And of course, if you see a recovery, there's a bit of hope, relief, and optimism. Now, the chart that I'm showing here today is very simple because it's just one cycle that you're seeing. Now, in reality, you go through this cycle in a very different manner, because you'll reach a certain point of euphoria, and then anxiety will creep in when there's a collapse. And now, of course, very quickly, when you see a bit of recovery, there will be hope and relief. So this is basically what people who have been investing in the stock market over the last 1 year will probably be facing, because of the volatile market that we are seeing, that we are facing. Now, but if you take away the charts, right, basically what you're seeing is a set of emotions that, you look at euphoria, thrill, excitement. These are all just a set of positive emotions and a set of negative emotions like panic, depression. So by recategorizing these emotions and recognizing these emotions and how it affects your investment decision making, you learn to be able to manage that. So what I'm going to do here, I'm just going to throw it all aside, and we're just going to bring in to this, classify these positive emotions under 4 more. Now we are what we know as fear of missing out. So when you're chasing after a stock market, for example, if you're seeing prices that are going up, for example, I think over the last 1 year, we saw a lot of rush into GameStop. So some of the stocks that are really, really hype up by the retail investors, and there's a lot of euphoria in it, right? People talk about how the retail investors are beating the institutional investors. Now, all of these are in a way positive stuff, but you need to learn to recognize that your investment decision making are not driven by all these emotions alone. Now, if you look at the next set of emotions, which are your anxiety, your fear, your panic, your denial, your desperation, all these are under FUD, which is your fear, your uncertainty, your doubt. So when the market start to collapse or when the share prices did not behave as per your expectation, you start to have this kind of emotions that creep in, because it's only natural to have that, to be honest, because a lot of times there are a lot of uncertain events that happen that triggered this sort of market movement. So for example, we see the Russia-Ukraine war this year. So those are things that really led to the market movement that we are seeing, right? And of course, the US rising interest rate environment. So all this will create a lot of uncertainties to an investors. Now, so we are here to try to help you to recognize this emotion so that you know that, at the end of the day, you need to look beyond that emotions and re-look at your investment portfolio and understand why you first invest. So I'm just gonna let you through this next slide, which is, I will call it something like you getting into a relationship, right? So when you first enter into a relationship, you always get very excited, right? You will be talking with your friends about what you'll be doing on date night. So you'll be trying to understand what works, what doesn't work. You'll be Googling what's the best place to date. So there's a lot of fear of missing out on the best places to date, right? So you are very, very excited about your relationship. So that's what it is when you started investing. It's basically like how you first started getting into a relationship. But as things goes by, right, you start to feel a bit of uncertainty. You're not sure if this person is compatible for you or if there is a better person that suits you. So it's just the same, right? When you're investing, after a while, you start to feel a lot of uncertainty, especially when things do not go according to your plan. So there's a lot of doubt that crept in. So you need to learn to recognize this emotion. And I want you to know, as long as you're investing, you will see this cycle repeated over and over again, because it is quite normal when things are going great that you will be chasing after it, that there will be a lot of FOMO in it. And when things start to turn back, things start to go south, you have a lot of FUD that came in. So the idea is to recognize that this is normal and that you will actually face and you will go through these psychological states as you continue your investing journey. So let's just take a look at the lessons from cryptocurrency market. So if you look at the book that is on the slide here, you can see that the market has gone down significantly from its high, right? So let's just take a look at the charts here. Now, just last year, it reached 70,000, so which is at an all-time high for Bitcoin price. So there's a lot of euphoria at that time. People are talking about, it's going to reach 100,000, 200,000, that sort of forecast that are coming out. So you can see when things are going great, people tend to be more bullish and give a more bold forecast and probably sometimes foolish, but it shows the kind of emotions that people would be in, right? So, but when things turn sour, right? So for example, if you bought into Bitcoin last year at 70,000 or at 60 plus thousand, today it's at around 19,000 and below. So you'll be feeling that pinch because you have lost more than 50% of your value, right? Now, having said this, now that I'm looking at it on hindsight, it's very easy to see this. But if you are investing in the real time, which is what I'm going to show you here, so you can see that if you're looking back in February last year, right, 2021. So at 40,000, is it a good time to buy, right? And there was a correction back then. So if you are trading in Bitcoin and if you decided to sell at the time, you miss out on the bull run that goes up to 60,000. But if you have sold it, right, then you would probably avoid that sort of calamity that people are facing today. Now, there's a lot of if when we look back at it, but what I'm trying to show you is that whether you're looking at it from a technical indicators, which will show you various signals on buy and sell signals, right? So those will tell you a certain investment decision that you should take. But at the end of the day, you need to understand, why are you investing in this market? For example, why are you investing in Bitcoin? You need to know that, because if you don't have a real understanding of what the investment asset or what does the Bitcoin is doing, then you are basically speculating. So that's why you will be very emotionally involved, because you are only buying it because you wanted to make a quick money. I'll go to that later, but I'm just going to show you for someone who, honestly, I'm not exactly familiar with the cryptocurrency market, but I have friends who really believe in Bitcoin and in the blockchain, because they talk about the decentralized investment as the new future. So there are people that try to understand the technology, and there are people that talk about it, and they really do their homework to understand how it works. And so if you look at it, if you've been buying it since when it was below $10, you will still be making money, right? But again, like what I'm trying to say here is, on hindsight, it's very easy for us to talk about it. But if you are doing it on a live trading basis, or when you're investing it, you actually feel the pressure, those emotions that I talk about, those uncertainties, those doubt will creep in. And so you got to revisit the reason why you invest in the digital, the investment asset that you believe in. I'm also talk about the lessons from the glove mania in 2020 and 2021. Now, if you are familiar with the glove stocks, then you would know that there's a glove stock mania in 2020 and 2021, mainly due to the pandemic. So of course, during the pandemic time, a lot of people would buy into the gloves. So basically, earnings were boosted by those demand, right? So this has led the share price to go up to 9 ringgit, and it's really, if you look at it again, it for investors who are buying it from below 1 ringgit, it really makes a lot of sense for them. But if you've been chasing it at 9 ringgit and 7 or 8, you'll probably be feeling the pressure because you've lost more than half of the value that you have right today. So again, this is the same, similar as what I showed you just now. If you look at it here, you can see that, you know, at 5 ringgit towards the end of 2020. So you probably felt that, you know, that there's a bit of correction in the glove stocks. This is top glove, by the way. Yeah. So you probably felt the pressure to sell because you probably have made quite a bit of money. But if you sold at that time, you miss out on the rally that goes up to 9 ringgit. Now, again, the question is, when you're investing, there's a lot of decisions that you have to make. So the buy and sell decision, you have to be able to justify the reason why you're buying and selling. So personally, for myself, for example, if I were to buy into stocks like that have gained more than 100%, to me, I think that sort of run is a bit too much, and I would probably take some of the profit from, say, initially I invest in 10,000 ringgit, right? If I were to make 20,000, I'll probably sell off my 10,000 and put my remaining 10,000 and continue to re-strategize my investment portfolio as the market move. So those are things that you need to look into, and you have to be rational. But if you're chasing after the market based on emotions, then you tend to be affected by the market. Bear in mind that you have no control of the market movement. You only have control over your emotions. Now, I want to say this because the market movement is dictated by a lot of variables. Now, there are people who invest in the stock market to speculate. There are hedge fund managers who invest in it to hedge their investment interests. There are those who invest in the long term. And of course, there are those who just buy into institutional funds, right? So you need to know that there are a lot of market players in there, and the share prices will move, and those movements will be dictated by all these variables. So regardless of the technical signals that you could have, you know, there is still a chance that you get it wrong. So you need to be able to prepare yourself for that mistakes, or for that uncertainty that comes out about, right? Now, this is just last year, the last 4 years that I've been showing you. But if you look further than just the last 4 years, for example, if you look at back in 2018, right up to 2009, right, you can see that Top Glove has the share price has rallied quite a bit, you know, from below 50 cents going up to about 2 ringgit. Now, these prices have been adjusted after the stock has been split. So you can see that if you are long-term investors in companies and you believe in the business fundamentals, for example, if you believe that gloves are good business, you'll be buying into it and you'll be accumulating dividends that are being paid out to you. And of course, if you've been buying from that since then, you will probably not be afraid of the panic selling that you're seeing today. But look a bit further, right? Before 2008, so you go up to 2002. So I'm showing this because I just want to show you that the cycle that we are seeing today is not the first time that we've witnessed it. Back in 2008, during the global financial crisis, right? So Top Glove shares were also affected by it because of the slowing economy. So you can see that in 2007, after it has reached its high at the time, it actually collapsed and it came back down. So you can see from 40 cents, it came down to about 15 cents. So there's a bit, you also lost more than half of the value that you are investing. Of course, the magnitude that we are seeing today is compounded by the effect of the pandemic, which has disrupted the economic environment for quite a bit. So you're seeing that kind of shock that the market is experiencing. So the changes would be probably, in terms of the magnitude and the size, would be much bigger, right? Okay, so to the moon and back. So I'm just going to show you this. So if you've seen the GameStop phenomena, you will know that people have been buying into it. And so at one point, people have been talking about how retail investors can beat institutional investors, and it's a good thing for them, because if you sold your price at 300 plus, you've been making a lot, 100 plus percent, 200 plus percent. So that's the kind of gain that we are talking about, especially over the last 2 years, right? But if you've been holding it, then you see that, stock tumble. And of course, once the frenzy die down and investors start to cash out, the market actually collapsed. Similarly, for Bitcoin, you can see that there's a huge drop from its high over the last 2 years that we've seen. So that's the kind of phenomenon that we're experiencing. And when you face this kind of situation, we need to learn to manage that emotion of yours, which is what I'm going to talk about next. So how do we take emotion out of investing? Now, I'll be very honest, and I'm going to tell you that it's impossible to be trading and investing entirely out of emotion. But what you can do is you can minimize that emotions of taking control of your investment decisions. So the first thing to do is you need to go back to understanding why you first invest. So there are a lot of reasons why people get very afraid when the market collapses. Part of the reason is because a lot of people speculate while thinking that they are investing. Now, I wanted to differentiate this, because when you're speculating the market, you're actually trying to make a lot of money in a very short span of time. And I want you to know that investing does not give you that, or most of the time it does not give you that. Occasionally, if you're lucky, yes, you could probably make a lot of money in a very short time. But the idea of investing is to accumulate wealth, and you need to learn to understand this concept that when you invest, you are trying to fight inflation. So of course, I know it's a bit counterintuitive, because today we saw that the share price has come down because of the inflationary pressure. But I want you to know that in the long run, what will be able to beat inflation is businesses. So most of us are employees. I myself is an employee. So we don't have a business. So the best way to tap on businesses are to invest in the stock market. So by investing in the stock market, you're able to invest in businesses that could increase their prices. That will help you to fight inflation rather than just holding on to your cash. Of course, some of you are investing to build your wealth. Now, some of us have a more specific agenda. We probably wanted to invest for like a certain period of time for our travel funds or even education funds for kids. So those are different goals that you have. And of course, some of us invest to gain a recurring income. So these are probably for those dividend investors or those who invest in the REITs market. So some of us are investing because we are earning a lot of money. So we want to enjoy some of the tax savings from investing. So that's also one of the reasons why. Or maybe some of us are just investing for retirement. So these are the different reasons why we invest. But regardless of the reasons that you're investing, you need to understand that. So if you are trading and you're investing and you think that you wanted to gain that exposure through investing, you need to first ask, why do you want to gain that exposure, right? So at the end of the day, I believe it's about building that wealth. And by knowing that reason why you're investing, you'll be able to resist the emotional decisions that will creep in, especially during a bear market. Now, I want to talk about the next thing, which investing is a personal journey. Now, just because something works for someone else doesn't mean that the same strategy done will work for you. If you look at the images here, there are different characters from Star Wars. I'm a big fan of Star Wars, so I'm using that as an example. So you see the story for Princess Leia, right? It works for her in Obi-Wan Kenobi series if you watch that show, right? But it doesn't work for characters like C-3PO or even for Darth Vader, because they're all very different individuals. And I want you to know that when it comes to investing, it's a very personal journey. You can't compare your investment return with your friends, and you can't just be trying to see who is making better returns or trying to just follow whatever that your friends are doing to try to make that sort of return that your friends are gaining. I'm going to explain that in a while, but get that into your mind first, because a lot of times we thought that investing is something that can be very generic, but it's very personal because it depends on your time horizon. It depends on your wealth. It depends on your cash flow. It depends on your characteristics as well. So I'm just going to share a bit on my side. So how do I start my investing journey? Now, I started off investing when I was still studying in university. So I was lucky in a sense because I got into University Malaya. So basically, partially of the cost of my education fund are subsidized by the government. And I also managed to get scholarship from Great Eastern. So what I was able to do at the time was I was able to use the scholarship money and invest into certain companies in Malaysia that are very consumer driven, consumer staples, companies that produce foods, things that we eat and things that we use on a daily basis. So I was basically looking for investing in the long run. But that strategy that I was using back then is because I have a pool of money that came from scholarship, right? So some of us might not have that. So if you do not have a pool of money that you can invest in, you're probably investing based on your cash flow. So on a monthly basis, you probably have about 3,000 Sing dollars, and you probably, after your expenses, you probably have about 500 left. So you probably can only invest on a gradual basis. So it's a very different strategy for me than for you. Similarly, I wanted to say that, for someone who is coming from a wealthy background, for example, so they probably have a lot more money to as a startup investment fund for them. So it would be very different from them as compared to someone who come from a middle income family. And it's also very different for someone who is still studying and someone who is already working. Because if you're studying, you don't have a recurring cash flow, positive cash flow that you can actually invest into, right? So you probably be investing based on your savings. So unlike someone who's working, that person will be able to generate income on a monthly basis. So it's a very different environment altogether. So you need to understand that investing is a very personal journey. Just because it works for Bailey doesn't mean that it will work for you. So you need to know what you're investing for. If you are already reaching the retirement age, for example, you probably don't want to tap on investing entirely of all your money into equity, because you might be facing a bear market, and and you'll probably be suffering when you reach your retirement age, right? So those are things that you need to look into, because those are the different situation or circumstances that we are in. So this is why it's very important to know that investing is a very personal journey. Now, thirdly, as I said just now, now investing is not a zero-sum game. Now, a lot of us thought that, oh, I make a lot of money from investing, or oh, someone lost money. But it doesn't mean that when you make money, someone else is losing money, because at the end of the day, investing is about meeting the needs of investors who are having different needs. So I'm just going to give you a perspective here. So if you look at the image here, you can see that there's a retiree who's probably wanting to sell the high growth stock that he has held with great potential to a young investor. Now, why? Because for someone who is retiring, you probably wanted to have a more stable portfolio. So you probably don't mind having fewer gains in the future, as long as the volatility in your portfolio can be reduced. So that's probably what you're aiming for, right? But for someone who is young, for example, someone who's like myself, I'm looking at 20 years example. So I probably have that longer time horizon to allow me to buy into companies that I think have potential for future gain. So for example, people have been talking about EV today, right? So if you're telling someone who's reaching a retirement age to buy into EV, that's probably not suitable, because there's a lot of risk that is involved. But if you're telling someone who is just starting their career, is just at 20 plus or is 30 plus, that probably makes a lot more sense, right? So at the end of the day, you need to know investing is not a zero-sum game. It's not about trying to maximize your profit. So it's not about trying to sell at the highest all the time. It's about making that investment decision that make sense to your circumstances, that can meet your needs. Now, fourth, invest like a businessman. Now, I think that a lot of times when we invest, a lot of people just look at the share price and how it moves. So people talk about the market and they talk about, oh, the business are not doing well because the share prices has collapsed. Now, that's partially true, but it's also dictated by a lot of other variables, a lot of other factors. For example, valuation could be high, or maybe just because macroeconomic environment is not conducive, so the market is not doing well. But when you invest, especially those who invest in the longer term, you need to invest like a businessman, because you need to look at the future cash flow of the company. You need to look at the company's competitive advantage. I'm just going to take an example. Recently, you realize that Apple has launched its iPhone 14. I know that those of you in Singapore have already got your iPhone 14, but in Malaysia, we probably have to wait a couple of more days. So if you look at the company, right, share price has not been doing so well this year, partially because of the investors shifting away from the growth and tech stocks. But if you look at the company in terms of business, cash flow wise, for Apple, it's still doing very well. In terms of competitive advantage, I think that it will be its Apple ecosystem. People who buy into Apple probably love the Apple ecosystem. They'll probably be using the Apple iWatch and everything around Apple, right? So that's the competitive mode that Apple has. And in terms of management track record, so while we have a new CEO since Steve Jobs passed away, but the track record has been pretty positive. So it's something that investors can look into. In terms of growth trajectory, I think we are talking about more usage of IoT. We are talking about more tech-driven environment going forward. So that growth trajectory is pretty well. in terms of competition in the industry, I think that just to put into perspective, 50% of people in US is currently using Apple iPhone. So that's in US, right? And you're seeing that sort of dominance that Apple has on the high-end market for smartphones. So that is the kind of thing that you want to look into. And it's not just Apple. That's just an example I'm showing. There are a lot of other examples. There are a lot of good companies that you can look into. And most of them are also not doing very well in terms of their share price this year. And if you are an investor, you probably will not you probably be very afraid because of if you're just looking at the share prices. But if you look beyond the share prices and you look into the company's fundamentals, the development of the companies, then you'll probably be more optimistic and you probably take comfort that, you know, the management is still trying to innovate and improve the company's competitive edge. So like I said, if you want to manage that emotion, learn to invest like a businessman. Now, fifth, know your risk tolerance. Now, everyone have different risk tolerance. I know that, when it comes to investing, higher risk means higher return, but doesn't mean that that risk is suitable for you. So the question is, can you stomach a 50% drop in stock price over the short term? So for example, if you buy into Bitcoin or in the crypto market, if you can't stomach that 50% drop, you're probably not suitable to buy into that market. And you also need to ask, what kind of investors are you? Are you looking at growth or income, or are you looking at a combination of both, right? So because different asset classes or different stock market would probably give you a different sort of risk profile. And the key question to ask yourself is that whenever you make an investment decision, can you sleep at night knowing that, if you not knowing the share prices movement, if you are comfortable to do that, then you probably know the answer that you could invest in the company. But if you can't, then you probably know that you are taking risks beyond what you can manage. So the idea is to know your risk tolerance, because you don't want to be caught in a position where you've put in you take on extra risk, and when the market does not pan out as per your expectation, you become uncertain and make decisions that are detrimental to your portfolio. Now, 6, prepare your emergency fund. Now, there is a need to look into this because a lot of us never think about job loss. We always assume that things will go our way, but we have to consider the fact that, there could be emergencies that arise, like medical emergency, car repairs, or even home fixes. I'm just going to share a bit of my own experience. So I think about more than 10 years ago, I bought a place, I bought a condominium. So after a couple of months about close to a year staying there, I realized that there's some leakages and everything. So there's a need to fix the house, right? So if I do not have the emergency fund set aside, then I will actually have to tap on my investment portion. So I'll probably be selling at a time when the market is not favorable to me. So the idea is to be able to set aside a certain funds for emergency. So this is, I think, if you follow Tim's previous session on Easy Peasy, he talks about asset allocation. So I think those are areas that we need to really look into before we jump right into investing, right? So that's the need to have that investment and discipline so that you'll be able to manage that emotion, especially during a bear market. Now, 7, now never invest in something that you don't understand. Now, this is a quote by Warren Buffett, as per mentioned by Insider. It says, if you told me you own all the Bitcoin in the world and you offer it to me for $25, I wouldn't take it. Now, what would I do with it? That's what he said, right? And bear in mind, Bitcoin is trading at, even after the collapse, it's trading at 18,000 level. So that's pretty much, right? But Warren Buffett said, even for 25, I'm not going to take it. Now, the reason is very simple, because when you invest in something that you do not understand, you are basically speculating, you're basically taking risks by hoping that you will be making money out of it. It's more or less gambling rather than investing. Now, the idea that you are investing in something that you do not understand is foolish, because now I know that some of us might say, it's okay, it's just a small portion of my money, right? Which is true. But that small portion of your investment that you put into something that you do not understand could accumulate if you do not have a discipline. So the idea is that never try to invest in something that you do not understand. If you want to invest in crypto market, for example, try to understand what it is about. Try to understand what are the technology that will enable them to be better. So those are things that you probably want to read up and understand, or even talk to people who know about it. Now, 8, the last one, prepare to hold investment for at least 5 years. Now, I think that a lot of people expect, holding stocks to be something that is very, like what the first picture that you see is basically like, a straight line, but it's not. When you're holding a stock, you actually go through a lot of challenges because the market is a cycle. There will be times when the economy is doing well. There will be time that the economic will struggle. So if you look at what we saw back in during the pandemic, there was a sharp decline during the initial stage when the I think WHO announced the pandemic, and of course there's lockdown globally. So we saw that sudden drop in the market, right? So those are things that people need to learn to face. And it's not just during the last pandemic that we saw. Even if you look at this year, you've seen a lot of volatility in the market. There's a lot of questions about whether the rising interest rate environment will actually lead to a bear market, that a prolonged bear market that could last 3 to 5 years. That sort of questions. So those are things that you need to be prepared for. And why did I say 5 years? Now again, this is based on historical standards. Again, we do not have an eye on what the future will hold. But historically, what we saw is that a bear market lasts between usually 3 to 5 years, longest about 5 years. So at least give yourself that mindset that you will hold at least for 5 years in the event that you are buying during a bear market. Okay, now just gonna recap. So how do we take emotion out of investing? So first, know why you invest. Secondly, understand that investing is a personal journey. Third, understand that investment is not a zero-sum game. Fourth, invest like a businessman. Fifth, know your risk tolerance. Six, prepare an emergency fund. Seven, never invest in something that you don't understand. And last but not least, be prepared to hold the stock for at least a minimum of 5 years. Now, if you look at the picture here, I'm just going to give you that illustration. It's a bit quite funny for me because when we go shopping, right, we are very excited when we saw 50% decline, or 50% discount offer, so we will want to buy. I still remember during the pandemic, I think Adidas was having that discount 50% for their shoes. So I was like looking at the most expensive shoes so that I get the biggest discount. So that's the kind of excitement that I have when I shop, right? But when we look at the stock market, when we saw a 50% decline in the market, we become panicked. We are like, oh, what's happening, right? I mean, I get the emotion and it's normal. Like I said, you will feel the pressure, you will feel uncertain, you will be questioning whether you have made the right decisions, but always revisit, the reason why you're investing. Answer those questions that I've talked about, whether you're investing it for the long term, you're looking at it as a business, or you are basically just speculating. By knowing that, you will be able to manage that emotion and take advantage of the bear market, when prices of asset classes are more reasonable. So this is basically what I want to share with you guys. And with that, thank you for everyone. So I'm just gonna go to the Q&A session. Let's just stop sharing first. Okay. Oops. Okay. Right. I'm just gonna start this by when I first invest that I'm just gonna give a bit of that the questions that we really ask ourselves is that when is it the right time to sell our stocks, for example, right? That I think that is something that you need to ask yourself. For example, are you investing in the business because you believe in the long-term fundamentals of the company? And if that's the case, you need to ask why you like the company. So I'm just going to give an example. I'm a big fan of there's a lot of people who call Apple fanboy, right? But I'm a big fan of Microsoft. Personally, I look into the company back in the time when it was Steve Ballmer. I think the company was doing very bad, right? So when they announced a new CEO, which is the current CEO, Satya Nadella, and I was very excited because it's finally driven by someone who knows tech. So because I was thinking that, this is the revival of Microsoft, finally been waiting for years for that. And that's because I love the product partly. And when I look into it and I look at some of the things that the company is doing and, the shift towards cloud and how the company is becoming more open during Nadella's time to involve a lot more collaboration with other tech players. So that's when I look at it and I saw the strength in the company. And of course, if you look at the company's balance sheet, you will see that, the company is very strong financially, and there's a lot of room for acquisition and for further investment. So those are reasons that I buy into the company, right? So the question is it, after it's gone up for so much, is it time to sell, for example? So that's the question that a lot of time we need to ask ourselves. And to me, the reason is very simple. If the company's share price has been going up because of the changes in terms of the fundamentals, and if demand remains positive and strong, and I'm positive on the outlook, I will remain holding it, and probably I will just take profit in some of it. But the idea is to keep my portfolio balance. It's not, if it's very simple. So if you buy, let's say when you buy your into equity at the time, it's you invest 10,000, right, dollars, for example. If it gone up by 100%, you'll be having 20,000. So if let's say you have a total of $50,000 in your investment, so that percentage of your allocation into equity would have increased. So you probably wanted to shrink that down and rebalance it. So the idea is to manage your asset allocation so that you are not heavily invested into a single stocks or single asset classes. I think okay, there's a question on what's your biggest investing mistake. Okay, that's a good one. I think the biggest investing mistake is the fact that sometimes when you are in love with the company, right? So personally, for me, when I look into the company, I like to look at the management, and sometimes we make that decisions based on how you see the management. And the mistake that I made was that I thought that the management was genuine and I love the product, but it doesn't pan out as per my expectations, and so things were bad, right? So and there's a lot of changes in terms of the management as well. But at that time, I decided not to sell because I was very much driven by my emotions, and I actually top up my losses. So that's the biggest mistakes that I made. What's your best investment? Okay, my best investment would probably be, like I say, I think Microsoft is probably my best investment. So because I started off investing quite early at the time, and again, the idea is to not allow your emotions to dictate your investment decision making. So I've actually made the decisions to gradually rebalance some of my stocks to ensure that there's not a lot of high concentration risk on a single stock. So that's what I've been doing, right? So allow myself to be more driven by a more rational investment decision rather than just purely on my emotions. Is it good idea to sell out of FUD if I currently hold a position in the China market? Now, I think that is a very interesting question because the Chinese market has suffered quite a bit, I think, especially over the last 1 to 2 years. Now, the questions that you need to ask yourself is, firstly, you need to ask, why do you invest in the China market? Now, personally, I do not have holdings in Chinese market. Now, the reason is very simple because there is a bit of, I would say there's a lack of transparency in the Chinese market as compared in some of the more developed markets. So, and I'm not personally in China, and that's also another reason because there's not a lot of visible traction that I could gain, right? And the fact that the Chinese government has quite a bit of say in how the policy would go forward, that is also something that I look into, because if today they say that all tech companies cannot make profit, then the tech companies will collapse, right? So that's a lot of uncertainty on the front. While I do not think the Chinese government will do that, what I'm trying to say is that I do not invest in it because I don't have the visibility and I don't find that there's a lot of transparency in the market. But if you invest in China, for example, I'll just give an example of a stock. For example, if you invest in NIO, right, the company is in EV, and you believe in its rechargeable services business, and you like the idea that, I mean, everyone is talking about the shift towards renewable energy. So if you are a believer in that, right, then you probably wanted to hold on to the stock despite of the market volatility, right? But if you are investing in the Chinese market just because you heard someone say that the Chinese market is going to recover and rebound, then you probably wanted to revisit that, because how sure are you that the market will rebound? Because yeah, it might rebound, that's true, but it probably rebound 3 years, 5 years down the road, or or it might not occur as what people have been saying. So those are things that you need to look into and ask yourself that questions. Of course, secondly, you need to ask yourself in terms of your cash flow. I guess that's very important. Like I say, it's very personal. if you are someone who has quite a bit of cash flow on your hand and you're not afraid of holding up, then it's probably a wise decision to take advantage of the market weakness and buy into some of the good names in China during the bear market that we're seeing. But if you're not, and if you are, if you're from a middle income class, and if you're not so certain about, your cash flow over the next 3 years, then you probably do not want to take that kind of risk. So the idea is about, again, knowing the companies that you're investing in, and of course, personally, your own circumstances, right? And another thing to take note of is that not everyone has the time to look into the market. I know that, for example, if you are a doctor, right? So if someone is a doctor and you probably do not have that kind of time to invest in the stock market, it doesn't look at the news like what we do on a daily basis. So you probably miss out on some of the developments in China. So if you are working in that kind of profession and if you do not have the time to monitor the market, then it probably makes a lot of sense not to invest in markets that are very volatile, that are influenced by a lot of this news flow that will be coming in. So that's probably my take on that front. Let's see. Okay. Is it better to invest in a company that you are interested in? I think yes and no. Firstly, because if you're interested in the company, you'll be likely more emotional when it comes to it. Like I said, one of the worst investment decisions for me is that, invest in a company that I kind of like and it doesn't pan out as per my expectations and I got emotional about it, right? But again, if you're not interested in the company, you will probably not be doing as much homework to find out about the company. So I think it's a matter of balance, is that you need to know that when you invest in the company, and you need to know your bias. So again, like I say, it's that preference. So if you are someone who is biased towards, say, Apple, you probably love Apple because you love the product, you love iPhone, you love iPad, you love all the products that look very beautiful and you just love them. You probably buy all their products during the launch as well, right? So you probably think that it's a good idea to invest in it, which is good if you do your study and research on the company. But if, let's say, you do not understand enough and you allow yourself to be influenced by your love for the company, then that's where the danger is, because you probably will not see the error in the management because you have a certain bias. So it's very important to recognize those bias. Personally, I know that because, like I said, that's probably one of the worst investment decisions that I make. So you need to recognize that bias if you have that bias. But it's okay to invest in companies that you're interested in, because there's a reason why you're interested in the companies in general, right? If you like the company, it's most likely because the companies are doing well, or the companies are offering services and products that are great. So those are things that will provide add value to you in the long term, at least. So those are things that you need to look into. But if you are too emotionally attached to a company, then it's probably best not to do that, because then you will be making decisions based on your emotions. Okay, I just think I want to talk about one more thing, since I don't see any questions here. Just gonna talk about the part where I say never invest in something that you don't understand. Now, I think a lot of times we need to recognize that, reading information from Google does not make you an expert in the subject matter. So it's very important to know that. So for example, if you wanted to invest in a more technical business companies, for example, if you want to invest in oil and gas, it's very important to ask the right questions, like what are the upstreams and downstream, what are the differences, right? What are the services sector? So for example, if the oil prices were to go up, it doesn't mean that all the oil price company will make company will make a lot of money from it. Some of them, for example, if let's say the services company, that probably will not benefit from the rising oil price immediately, so it probably take longer time for them to benefit from it. So it's very important to know when you want to invest in something, whether it's in if you're into crypto or whether it's you're investing in stock markets or even in commodities, you need to understand the dynamics of what's going on, what is driving the demand and supply of that business. Sorry, there's another question on, will you advise the poor to invest since they may lose all the money? It's a game for the rich. No, I think that this is a wrong perception. I think that investment is probably the best way for the poor or for the middle income to actually build their wealth, because like I said, what is the best way to actually beat inflation? It is through business. And most of us, especially the poor, will not be able to start a business on their own, right? So the best way to do so is to invest in companies that are doing business, and that is stock market. While yes, you heard of stories that people lose money when they invest in the stock market because they don't know how to invest. So the reasons, like I said earlier, is about knowing that you're investing, and whether you're investing or you are speculating is very important, because if you are investing into a company, you will need to understand about the few things that I talk about: the company's cash flow, the business model, those critical issues that are driving the company's business. It's not so much about the share price. Yes, I mean, it's great to make money when you see the share price go up, right? But it's not so much about that, because eventually the share price will reflect the true value of the company. Whether it takes 3 years, 5 years, or 10 years, right? We probably don't know how long it will take for the market to recognize that value. So, I mean, if you look at the last decade, for example, I think a lot of the companies, for example, tech companies, a lot of the values are being recognized earlier because there's a lot of money in the market. So people wanted to take more risk. So which is why they are investing into tech companies like EV and all that. Even if those companies are making losses, they don't mind, because there's a lot of money in the market and they see potential in it, right? But if as we see a normalized environment where interest rate go up to a more reasonable level, then you will see that people will be more cautious in their investment. So they will not throw their money into say GameStop. They will probably not throw so much money into speculative counters. They will probably invest based on companies' fundamentals, things that have value, right? So the idea is that even if you are investing, because let's be honest, if over the last 10 years, if you've been investing in value stocks, right, say the consumer staple stocks, you'll probably be earning way less than those who are investing into growth stocks or that are not even making money, for example. So you'll be probably questioning, why do I even bother looking at the company's earnings and all that? But the idea is that you wanted to invest in companies that have value, right? So whether the value is reflected in 3 years time, in 1 year time, or in 5 years time, eventually it will be reflected. Because you can lie to I mean, even if the management is trying to even if the management is not good in running the business, right, they can't trick the shareholders the entire time. So eventually the true value of the company will be reflected. So the idea is that you need to look into it and invest in companies that have that fundamentals and could add value. So I think the easy questions that I always ask myself is this: when you invest in a company, is the company adding values to the community, for example? I think this has a lot to do with ESG as well. A lot of people have been talking about shifting towards ESG investing, that how it actually add values to community. And I think that's a fact, right? You want to invest in companies that could add value. So for example, whether it's in terms of entertainment, whether it's in terms of productivity, you want to look into it and invest in those companies that can bring value. Which is why, when the question asked about what's my best investment, I say Microsoft, is because the company, the vision and the mission of the company itself is about empowering businesses around the world to do better. And I think that's the idea, is that it's not just so much about just a single company that is doing well. It's about empowering all the others to do well. That values that it adds in is what's bringing value to the company. And I think it's also very much the same with Apple. If you look at the Apple ecosystem, a lot of app developers are also gaining from it. So there's a lot of values that are created through the ecosystem, through the development of the company itself. So those are the things that I will personally look into. So for someone who are not rich, I think the idea, if you want to build your wealth, the best way to do it, at least in my point of view, is through investing in the stock market. So, yeah. I think if you had 25 hours in a day, how would you invest differently? I'm not sure what that question means. So if I have 25 hours in a day, I don't think I would invest any differently from how I'm doing it today, because I know that there are some people who trade based on technical. So those are probably more important for if you're investing based on technical indicators and you're trading, right? So you probably want to strategize your investing strategies based on the timing of the market and everything. So, but for someone who are investing in the longer run, I think in terms of the timing and everything, it's not as significant as compared to if you're trading in the market. For traders, what I can say is that, I have friends who are very good at trading. So, and I respect those who are very good at it, honestly. But the thing is that the point is that even for good traders, they will not be able to get it right all the time. So there are times that you get it right, there are times that you don't get it right. So the idea is to create, even they will tell you, even traders will tell you the same thing. It's about having that discipline to cut loss and also to take profit. It's about that discipline that allows them to be good in their trading strategies. So yeah. Okay, I think since we have a bit of time, let me just share one more thing with you guys. Just give me a minute. Let me just. Sorry. Okay. All right. So let's just go back to this. I think so now I just want to share this with you again because I want to share this because when you're investing, right? So I mean, even though if I'm not investing in Bitcoin, you have friends that you expect you to have a bit of exposure in this market, so they'll be telling you things. So I still remember last year there were friends who just keep telling me about, the price at about 40 plus thousand and 50, it will go up. They were telling me, I've been monitoring the market. It is going up from 40,000, it jumps up by about 20%, and then it will come down a certain percentage. If you look at the trend here, is actually true to a certain extent, right? The trend actually remains for a certain period, probably 6 months period, before that changes because of certain changes in the external environment. So if you want to trade, right, for someone who are interested into trading, so you probably want to keep that discipline, right? So if you are seeing that trend and is continuing, you probably can use that same trading methodology. But if you are seeing a shift in that trend, so for example, instead of dropping by 20% or 10%, the market actually collapsed like 40% or 50%. So then you know that it's time to cut loss, even though if you're going to make losses. So the idea is that a lot of people can't do that is because, when you are making profit, it's okay. But when you learn that you're not making profit and it turns out to be a loss, that's when you allow your emotions to influence your investment decision. So I just want to show this because I just want to share this because I think that it's important to recognize that whether you are trading or whether you're investing for the long-term basis, it's important to have a set of discipline. You can't allow emotions to influence your investment decision making. All right, I think that's all from us. I didn't see any more questions. If that's all, I think we can end the session. Crystal, do I pass it back to you or can we just end? Oh, okay. All right. So that's it for tonight. Thank you for joining us. Have a good night. Bye.